On October 1st at midnight, non-essential government functions shut down after Congress failed to agree on a continuing resolution. Now that headline boosted gold as a flight to safety trade, and it weighed a bit on risk assets. Now the S&P 500 slipped about 0.25%. Not a panic, but a reminder that policy dysfunction is becoming a market factor. Then on Wednesday morning, the ADP employment report landed, and it drew outsized focus going in for two reasons. One, mounting questions about the recent BLS accuracy and the risk that this week's BLS release could be delayed by the shutdown. Now a third reason emerged once the number hit, the downside surprise itself, showing a loss of 32,000 private sector jobs versus expectations for a 51,000 gain. Now the miss shifted focus back to a weakening labor market. Now, interest rates moved first. The 10-year Treasury yield dipped from 4.14% to 4.10%, and expectations for Fed easings ticked higher, with the CME FedWatch tool now signaling roughly 44 basis points of cuts by year-end. Now, equities are caught between clear signs of a softer labor market and the prospect of a more accommodative Fed. Now, if the labor numbers do arrive on October 3rd, that print could be the next catalyst for the S&P 500 direction. Now, if a trader believes the S&P will move higher from here, they can express that by buying the December micro E-mini S&P futures contract at 6735 and target a move to the psychological level of 6850. Now, a stop for this trade can be placed below at 6650. This trade can make $575 if the target is reached and risks $425 if you're stopped at your level. Now, if a trader believes the S&P could pull back from here, they could express that by selling the December micro E-mini S&P futures contract at 6735 and target a move to the 50-day moving average, which will come in at about 6600. Now, a stop for this trade can be placed above at 6820. This trade can make $675 if the target is reached and risks $425 if you're stopped out of your level.